Okay, welcome back, everyone. This will be Principles of Accounting 2, Chapter 24, Differential Analysis and Product Pricing. I like using a funny voice. Okay, so differential analysis. The concept of differential analysis allows for managers to make decisions involving the choosing between two alternative courses of action. The concept here is the difference between two possibilities. So in other words, an example would be, we have a manufacturing facility. We are a auto manufacturer. We are trying to decide between making two types of cars, we'll say. We have the Tesla Model C and the Tesla Model Z. And so these are our two choices that we have to manufacture. And so the manager will make a decision based off these two models to manufacture one of the or the other. And so that this course of action involves two choices. So there's a couple of steps that a manager must follow in the selection process of these options. So although a managerial decision process varies by the type of decision, it normally involves these following steps. First, you got to identify the objective of the decision. So why are we making this decision? Is it based off of maximizing our potential income? Is it based off of saving cost? What is the objective of the decision? The second thing we must do is identify alternative courses of action. So in the Tesla example, do we make car A or car Z, right? Those are the alternative courses. Step 3 is we got to gather all of the information and perform a differential analysis. So the cost of both cars, the amount of labor for both cars, the overhead for both cars. That's gathering all the information. And then we need to analyze the differences between the two cars. And then, of course, we need to make a decision which car we're going to make. And then the fifth step, the last step, is we review, analyze, and assess the results of making that respective decision. So what is differential analysis? It's oftentimes called incremental analysis. It's where we analyze the differences between the revenues and costs of either decision or either product that we want to make in order to determine the difference in the impact on income between these two alternative courses of action. So first we look at the revenue. What is the difference in revenue? Differential revenue is the amount of an increase or decrease in revenue that we expect when we compare these two decisions. So when I look at car A and car Z next to each other, what is the potential revenue I can earn for either one? And what's the difference between the two? And so I want to do the same thing for cost. So I do what's called differential cost. I look at the increase or decrease in the cost that is expected from the production of either car A or car Z. And of course, I want to look at the differential income, the net income, right? What's the difference between manufacturing car A or car Z? What's the income potential difference? It's very similar to looking at your income statement, right? You have revenue, cost, and income. So this is the same as your income statement. You got your revenue from your sales, your cost from your expenses, and your net income or differential income. So there's a couple of decisions in management that we need to make when we're looking at our potential sale or potential cost. One of those is the famous lease or sell decision. This is where management needs to make a decision to either lease or sell a piece of equipment that is no longer needed. In making a decision, we can use differential analysis. Only the difference in revenue and difference in cost are associated with the lease or sell decision. So what we do is we look at the book value of the equipment as a sunk cost, and so we don't consider this in the differential analysis. Book value, as you know, is the present value, if you will, of the equipment. The present value, which is the book value of that piece of equipment, would be its current value, of course, after any type of depreciation for that equipment. And so that's what sunk cost is. So sunk costs are costs that have been incurred in the past, but we cannot recoup them like depreciation, right? And these are not relevant for making future decisions because, of course, I cannot recover the cost of something like depreciation, so therefore it's a sunk cost. So anytime you cannot recover a cost, we call it a sunk cost. Management oftentimes needs to make a decision whether to discontinue a segment or a product. This is oftentimes the case when a product becomes what we call obsolete or no longer relevant to the marketplace. This happened several times in history with like something like a television set. You guys are probably, some of you may be too young to remember, but most of you probably do remember. You remember the TVs they were huge back in the day, right? They were so big and bulky and heavy, and they literally had a tube in them, right? That's why we used to call it the tube, right? That was the name for the TV because they were so big and bulky, and they had to heat up to turn on for the picture to come on. So over time, that was replaced by the newer models. And now, when you look at the TV, and it's very thin, you know, it's razor thin. They're flat, yeah. And this is because technology evolved over time, and so over time, manufacturers discontinued manufacturing the tube TVs because they were no longer in favor. And so, a product, department, branch, or territory segment of a business at some point will be generating a loss. For example, the tube TV started generating a loss because nobody wanted to buy it anymore. So as a result, management decided to eliminate the product from sales and manufacturing because, again, it fell out of favor. So that's the reason for discontinuing a product. Discontinuing the product or service or segment usually involves eliminating all of the product or segment's variable costs, such as direct materials, direct labor, factory overhead, and sales commissions. So again, with the tube TV, we no longer had a need to manufacture it, so therefore we can eliminate the related variable costs, the direct material to make it, the direct labor to make it, and of course the factory overhead and sales commissions that were involved with that product. So however, there's one cost that remains, and as you know, it's the fixed cost. So fixed costs such as depreciation, insurance, property taxes, rent, mortgage, etc. We cannot eliminate that because the building still exists, right? And so therefore the fixed costs do not get eliminated. Only the variable costs associated with that product get eliminated when we discontinue the product. Does this make sense? Hopefully. Wonderful. And of course, management has to make a decision on what we call the make or the buy decision. So companies that manufacture products that are made of components that are assembled in a finished product, like an automobile, they must decide whether to make a part or purchase it from a supplier. So an example, Ford might make the decision to purchase the transmissions that go into their cars. They might decide to purchase that from a supplier rather than try to make it themselves. And the reason for this type of decision would be it's simply too expensive for them to try to make it on their own. And so therefore they might decide to purchase it from a supplier. And to make this type of decision, the managers could use differential analysis to decide whether to make or buy that part. And another differential analysis decision could be in the replacement of equipment. I remember I told you all this story about when I was the financial controller at Radisson Hotels. I told you the story about the chiller on the roof that broke, right? And so in that decision, we had to make the decision to either replace the chiller or to fix it, right? And so in that decision, we did what's called differential analysis. We ran the differential analysis. So the usefulness of a fixed asset may decrease before it's worn out. This happens when it breaks, right? So old equipment may no longer be as efficient as new equipment would be. So we run a differential analysis to make the decision to replace the fixed asset like the chiller. And so with that decision, we run the differential analysis. We use it to replace the fixed assets such as the chiller, equipment, or machinery. The analysis normally focuses on costs of continuing to use the old equipment versus replacing it. The book value of the old equipment is a sunk cost and thus is not relevant in the decision-making process. So the revenue that is foregone in the alternative use of an asset, such as cash, is called the opportunity cost. Although the opportunity cost is not recorded in the accounting records, it's useful for analyzing the alternative courses of action. As you recall, opportunity cost is what is foregone. It's kind of like the decision you made to come back to school for your education. What is foregone is the potential income that you might generate during the hours that you're in school, right? So that is the opportunity cost of going to school. It's the same concept applies in business. Another decision that we use differential analysis for is the process or sell decision. In manufacturing, the product normally progresses through various stages of processing, as you know. In some cases, a product can be sold at intermediate stages of production, or it can be further processed and then sold. An example is our car, our Ford car, right? We can either sell the base model, which is a part of that's at an intermediate stage of production, or we can further process it and put all the bells and whistles in it and then sell it, right? So you know what the base model is, right? You know, it's where you got the crank windows instead of the roll up and roll down windows instead of the automatic ones, or you got the heat knobs that you got to press in and turn the knob instead of like the digital ones, or you got You got the cloth seats instead of the leather seats. You know, the base model is just the basics. And then you can further process the car, and it's got all the fancy bells and whistles on it. You know, it's got the automatic mirrors, it's got the automatic windows, it's got the automatic heat and air, all that type of stuff, right? It might even have a remote starter, all the fancy stuff. So that's the difference of further processing it and then selling it, or just selling the base model. So differential analysis can be used to describe whether to sell the product at intermediate stages, such as the base model, or process it further and then sell it. Another decision that businesses make using differential analysis is the accept business at a special price decision. This is where a company may be offered the opportunity to sell its products at prices rather other than normal prices. Example, I might be exporting a product overseas, like a baseball or a basketball, for example. And I might be selling this product at a reduced price overseas because I want to get my product into a different market. And so I'll offer that at a discount price to suppliers. Differential analysis can be used whether to accept business at a special price. If the company is operating at less than full capacity, meaning we're under 100% capacity, then we can add additional product or add additional production that does not increase our fixed costs. Fixed costs are not affected by the decision and are thus omitted from analysis. However, as you would expect, selling and administrative expenses may change because of this additional business. So in other words, if my business is operating at less than 100%, let's say we're operating at 80%, and in order to fill the gap to get us back up to 100%, I might try to sell my product in a different market, overseas. Although I might sell it at a discounted rate, to get that 20% difference, I'm still going to have my selling administrative expenses. So those might increase because I'm still increasing my production by another 20%. Does it make sense? Hopefully, yes. Okay. Again, you're all on mute, so if you have questions, please unmute yourselves. Okay, so let's talk about setting prices. This is one of my favorite parts of business. How to decide what price to sell your product at. Setting normal product selling prices is a very important part of business. And what this is a way for us in the business to set target selling pricing. In other words, I'm going to set my prices at a normal rate. Usually this is like market pricing, right? So normal selling price is a target selling price. And this can be achieved in the long term, which makes it normal, right? It's kind of like when you go to the grocery store and you can get a whole pound of bananas for 49 cents or 99 cents. That's the normal price, right? It's been that price for a long time. And sometimes it goes up, sometimes it goes down, but it's usually pretty consistent in terms of its price per pound. That is the normal price. That's the target price for bananas, 49 cents, 99 cents, something like that. The normal selling price must be set high enough to cover our costs. Of course, we need to cover our fixed and variable costs. And we also got to provide a reasonable profit. So when the banana farmer sells the bananas to the grocery store, the banana farmer, of course, needs to cover their costs of farming, right? They got to cover their fixed and variable expenses, and they also need to make a little bit of a profit. So they'll sell their bananas to the grocery store for 40 cents, okay? And the banana farmer's fixed and variable costs are 20 cents variable cost and 10 cents for the fixed cost per pound of bananas. And they'll sell that to the grocery store for 40 cents, giving the farmer 10 cents profit per pound. And the grocery store, of course, sells it to you for 49 cents because the grocery store needs to make a profit too, right? And so therefore, the banana farmer is covering their fixed and variable costs and thereby setting it at a normal selling price of 40 cents to the grocery store. So also during this process, managers can use one of two market pricing methods. We have what's called demand-based concept and competition-based concept. In demand-based concept, we set the price according to the demand for the product. So if there's a high demand for the product, we set the prices higher. For example, toilet paper, great example at this time, right? So as we know, it's in high demand right now for some ridiculous reason or another. And so what we see is the price is rising for that product because it's now in higher demand. And as the demand goes lower, we'll bring that price back down. So likewise, if the demand is low for the product, we set the prices lower. Makes perfect sense. That's called demand-based pricing. Now, of course, we have what's called competition-based pricing. This is a fun one as well. So competition-based pricing is where we price according to what our competitors are pricing their products for. So let's say I'm Charmin and the other guy is Angel Soft, okay? These are toilet paper companies. So I'm Charmin, I'm the bear, right? And then we got the Angel Soft on the other side. And so I'm Charmin, so I'm going to set my prices, for $6 for a 6-pack, okay? And so Angel Soft might come in and set their prices at $5.49 for a 6-pack, okay? So that's 50 cents below me. And so that's what we call competitive-based pricing. And so therefore, I will reduce my 6-pack price down to $5.50. I want to be right there with my competitor, Angel Soft. And so we got to be competitive in our pricing. So I might reduce my pricing to match the price of what my competitor is selling for. We call that competitive-based pricing. So managers often use 3 cost-plus methods to the selling pricing. We use what's called the product cost concept, the total cost concept, and the variable cost concept. And I'll explain each one. In product costing, this is where, in product cost pricing, we use what's called the cost plus. Okay, this is where we determine the normal selling price by estimating our cost amounts per unit and adding in some markup. The markup, as you know, is the profit. We want a little bit of profit, so we'll put a little bit of markup in there. So to get this, we take our cost amount per unit and we add in markup. Of course, the markup is based off of what managements want their profit per product to be. That's what markup is. Markup is what management wants the profit to be per product. So the markup should be sufficient to earn the desired profit, and we have to cover any costs and expenses related to that product that are not included in the cost amount. Those would be things like factory overhead, salaries, so forth and so on, right? You guys remember that from earlier chapters, I know. So under the product cost concept, only the cost of manufacturing the product, those are your variable costs, are termed the product costs. So in other words, variable costs are product costs. And these, of course, are included in the cost amount per unit to which the markup is added to. Estimated selling expenses, administrative expenses, and desired profit should be included in the markup. So, of course, obviously, I want to cover those costs as well, right? And to do that, I want to make sure that my markup price is higher than all of my selling, administrative expenses, and desired profit. So the markup per unit is then added to the product cost per unit to determine the normal selling price. So let's look at that in an example. How we get to that cost. So the first thing I need to do is estimate the total product cost. Now, as you know, our product costs include direct labor, direct material, factory overhead. Those three things are always what makes up the product cost, the total product cost. So we add direct material, direct labor, factory overhead to get the total product cost. The second thing I need to do is estimate my selling and administrative expenses. Then after that, I divide the total product cost by the number of units I expect to produce and sell to determine the total product cost per unit. And the calculation for this is we take our total product cost and we divide that by the estimated units produced and sold. By doing this equation, we get our product cost per unit. Does it make sense? I hope so.
Yes.
Yes? Thank you. Thank you, Devon. Okay. Now that we've done that, now that we got our product cost per unit, we then need to figure out what's going to be the markup percentage. So to do that, we take our desired profit plus the total selling and administrative expenses divided by the total product cost. That'll give us our markup percentage. This is just like everything else we've done in this course. Everything is sequential, right? So you got to make sure you follow the steps. And if you follow the steps, that's how we'll be able to get through all the equations. The desired profit is normally computed by taking the desired rate of return, which you learned about in the last chapter. And we multiply that by our total assets. That gets us the desired profit. Then step 5, we determine the markup per unit by multiplying the markup percentage times the product cost per unit. So again, the markup per unit is calculated by taking the markup percentage that you got from step 4 times the product cost per unit that you got from step 3. And then in step 6, we determine the normal selling price by adding the markup per unit to the product cost per unit. So again, markup or product cost per unit plus the markup per unit to get the normal selling price per unit. And that is the product cost concept. Any questions so far? Are we good? We're good? Okay. So now let's look at what we call target costing. Now, target costing is a method of setting our prices that combine market-based pricing and cost reduction emphasis. In other words, I want to make sure my cost is low. I want to use my market-based pricing method. Now, under target costing, a future selling price is anticipated using the demand-based or competition-based methods. The target cost is then determined by subtracting a desired profit from the expected selling price. So to get target cost, we take our expected selling price and subtract out the desired profit. That gets us our target cost, okay? Target cost, how much it should cost, how much we want it to cost, basically. So the target cost is normally less than its current cost. That makes sense. Because again, the objective here is to reduce the total cost. So managers must try to reduce the costs from the design and manufacturing of the product. Again, if I simplify the design, that should hopefully reduce the cost. It's kind of like in the auto manufacturing world. They try to simplify things in order to reduce costs. So that's why you only see like a few buttons in the cars, right? That makes it simple. And so making a few buttons instead of a lot of buttons, a few buttons makes it simple. Therefore, the cost is lower. So the planned cost of reduction is sometimes referred to as the cost drift. So to reduce the cost, of course, what we do is we simplify the design. We can reduce the cost of direct materials by, of course, we do this by negotiating with our suppliers, right? Reduce the cost of direct materials. We can reduce our labor costs by, machinery. We can eliminate waste. We can be more efficient, in other words, in the production process. Now let's talk about another thing that impacts businesses and manufacturing, that kind of constrains businesses. This is kind of like a limit on business and production. We call it production bottlenecking. This is a situation where the demand for the company's product exceeds the company to produce the product. We are seeing this around the world right now in hand sanitizer. The companies that make hand sanitizer, like Purell, cannot keep up with the demand of the world for the Purell, for the hand sanitizer. And so this caused a bottleneck in Purell's manufacturing process, where the company can no longer meet the demand. So this is a constraint at which the point in the manufacturing process is where the demand for the company's product exceeds the ability to produce the product. And so we're seeing this with the hand sanitizer, the Purell. So they have a bottleneck situation right now in the production process. Now there's in this bottlenecking, we have what's called the theory of constraints. The theory of constraints is where manufacturing strategies focus on reducing the influence of the bottlenecks on the production process. In other words, we need need to reduce the demand for it in order to meet the demand, right? So this is the theory of constraint. So a company has a production bottleneck in the production process. We should attempt to maximize profits subject to the production bottleneck. In other words, I'm going to raise the price that I'm selling my hand sanitizer at because the whole world wants it right now. And so therefore, in order to reduce the bottleneck, I'm going to reduce demand by raising prices. Right? And so in doing so, the unit contribution margin for each product, of course, we utilize that in the production bottlenecking.
Professor, I thought they weren't allowed to raise the prices right now because of the pandemic. It's against the law.
The retailers cannot, but the producers can.
You'll make CVS or Walmart spend higher prices to receive the product to sell to their base. Okay.
Correct. Yeah. So what's happening right now is Purell is selling their product to the Walmarts and the CVSs of the world, and at a higher price. But what you see is that the Walmarts and CVSs of the world have not raised their prices to the consumers, so they're eating that cost. They're eating that rise in cost to protect the consumers, right? And so that's really what's happening, because we see that the manufacturers, they can't keep up with demand. And so they have to charge a higher price to their customers, which are the Walmarts and CVSs of the world. But the Walmarts and CVSs of the world, they will not raise the prices to the consumer. They cannot. It's a law, as Kiva said. And so what's happening is those retailers are eating the cost. Does that make sense, Kiva?
It definitely makes more sense. I just like that we're protected, because that's everybody's number one fear, is that everybody's going to raise the prices, which I guess that's what Amazon falls into place, where you see people purchasing things and then reselling them as their own store. So that's where they've been blocking a lot of that guy who bought like $70,000 worth of hand sanitizer and then tried to sell it for $70 a bottle. They had took his site down because that's against the law.
That's right. Yeah, and we see that happening in multiple instances, and it's very concerning to see that type of thing.
See people's true colors. I know. Very concerning.
Right. Yeah, that's exactly right. When people get scared, you really see what they're made of when that happens. Okay, so let's talk about total cost concept a little bit more, just to kind of highlight what this concept's all about. So under the total cost concept, manufacturing cost plus the selling and administrative expenses are included in the total cost per unit. I know we already talked about this stuff, but I just want to go over this one more time so that way you all understand what this is all about, because you will see this on the exam. And we'll talk about the exam after we're done with the PowerPoints. The markup per unit is then computed by adding the total cost per unit to the the markup is added to the total cost per unit to determine the normal selling price. And of course, as you know, there's a couple of steps here involved. There's 7 steps. The first step is to figure out your costs by getting your direct materials, direct labor, and factory overhead, adding those 3 things together to get your total manufacturing costs. You already know that stuff. I've been drilling that part into you guys since we started this course. The second step is to estimate the total selling administrative expenses. Don't worry, that'll be given to you. The third step is to figure out the total cost. You get your total manufacturing cost and add in your total selling administrative expenses to get your total cost. The fourth thing you do is to figure out your total cost per unit. You take your total cost and you divide that by the number of units you expect to sell and produce. The next thing you do is you figure out your markup percentage by taking your desired profit, how much money you want to make, divide that by your total cost. That'll be your markup percentage. Of course, to figure out your desired profit, before you can divide it by your total cost, to figure that out, you take your desired rate of return, you multiply that by your total assets. That'll get you your desired profit. And then you divide that by your total cost. And then, of course, the next thing you got to figure out is how much markup do I want per unit? To figure that out, I take my markup percentage that I figured out in step 5. I multiply that by my total cost per unit that I got from step 3. I'm sorry, step 4. And so the last thing I need to do is determine my normal selling price by taking my total cost per unit, adding that to my markup per unit to get my normal selling price per unit. So that's total cost concept. Now let's look at variable cost concept. Again, just highlighting the steps. Under the variable cost concept, as you know, only variable costs are included in the cost amount per unit, to which we add in the markup price. The variable manufacturing costs and the variable selling and administrative expenses are included in the cost amount. The fixed costs and fixed selling administrative expenses and the desired profit are included in the markup. They're not included in the variable costs because they're not a part of variable cost. The only thing that's variable in this concept are the manufacturing costs and the selling administrative expenses. The reason why selling administrative expenses are considered variable is because, as you know, they go up or down dependent on the amount that is being produced. The markup per unit is added to the variable cost to determine its normal selling price. So how does that work again? We take our direct materials, direct labor, variable factory overhead to get our variable product cost. Then we estimate the total variable selling administrative expenses. Don't worry, they'll be given. Step 3, we determine the total variable cost by getting our total variable product cost plus our total variable selling administrative expenses to get the total variable cost. Then we figure out our variable cost per unit, which is the total variable cost divided by the estimated units to be produced and sold. And then, of course, I can figure out my percent markup by taking my desired profit and adding that to my fixed costs and expenses. To figure out the desired profit, as you know, we take our desired rate of return times our total assets. Do that first. Then we add in our total fixed costs and expenses, and then we divide that amount by the total variable cost. So think of the parentheses need to be here, yeah, on the top. Order of operations, yeah. Then we divide that amount by the total variable cost. And then we got to figure out our markup cost per unit. We take our markup percentage that we figured out in step 5 times our variable cost per unit that we figured out in step 4 to get our markup per unit. And then the last step is we add that into our variable plus our variable cost per unit to get our normal selling price per unit. And that, my friends, is the end of chapter 24. So again, this was the abbreviated version of chapter 24. As you also know, the lecture slides have been uploaded to Blackboard for your use. Now let's talk about the exam. The exam will be open on Wednesday at midnight. The exam will close Thursday night. That's a full 48 hours to complete the exam. The exam will be 50 questions, just very similar to the midterm, a mix of true, false, multiple choice, and a few matching. There are no math questions in the exam. Those have been eliminated. You will have 48 hours to complete the exam. The exam will, and I'll make an announcement about this, and I'm sure a couple of reminders. It'll open on Wednesday, and it'll close on Thursday night. That's 48 hours. 50 questions, true, false, multiple choice, and a few matching. These will cover chapters 22, 23, and 24. Open book, open note, open slides, whatever. Okay, whatever you can do. Try to get the highest grade possible. You can save and close. You can come back to it, just like previous exams. Again, this exam is on Wednesday. It's not on Saturday. It's on Wednesday. The reason for this schedule change, this course is over in 2 weeks. Okay, so we still have 3 chapters to go. So instead of the exam being on the 11th, we can't. And the reason being is because we got 3 more chapters to cover for the final. And so we need that class time to cover 3 chapters, right? So on the 11th, so the exam will be on April 8th and April 9th. On April 11th, we'll cover chapter 25. On April 18th, we'll cover chapters 26 and 27. On April 25th, or maybe even earlier than that, you'll have your final exam. And the reason why the final exam, April 25th or earlier, is because most of you are graduating this semester. And so because of that, I need to have your final grades in by April 28th. So therefore, there's a shift in the schedule. We got to move it up a little bit. So that's why we're having the exam during the week, next week, or this week, technically. And that's why we're having chapter 25 on the 11th. Chapters 26 and 27 will be on the 18th. That'll be a long day for us. And then your exam will be your final exam will be the following week. So are there any comments, questions, or concerns? One question that Mary raised, and I want to make this announcement loud and clear. All of your coursework needs to be done and in by April 19th. All of your homework, quizzes, exams, your homework and quizzes need to be done by April 19th. There are no exceptions. They got to be in before the final exam is issued. Any questions, comments, or concerns? Now's your chance.
I had already completed all the homework and the quizzes.
Yeah, that's what I was about to say. Say, Professor, I got confused and I was a couple of weeks ahead, so I just decided to just finish.
Me too.
So Shanika and Kiva, you are both ahead of the game, and that's wonderful. What about you, Mary?
I'm getting there.
Getting there. Okay.
Come on, man. You can do it. You can do it, man. We got to
Thank you,
graduate.
Shanika. Thank you.
What about you, Camila?
Hello?
Yeah, go ahead.
Oh, I'm behind, Professor. I will try to do all my homeworks. I start on 19, so homework 19.
So
I finished
Cornelia,
my homework
work
19, but
as
I'm
hard as
missing
you
like
can.
20, 21 to 24.
Okay, I understand. Work as hard as you can, okay?
Yes, Professor.
All right. Are you okay?
Yes, I am. Thank you.
Great. Wonderful. Jewel, how you doing? Jewel, you're on mute, my friend. She's probably okay. That's all right. Marvin, you doing okay, buddy?
Good.
Good? Okay.
Yeah, good.
Good is good.
Professor. What is good?
Mary, we know how you are. You're getting there. That's good.
Yeah.
Maya, how you doing?
I got 3 more.
You got 3 more? Okay, that's good. You'll get there. It's all right.
I'm gonna knock it out before the 17th.
Great. I would appreciate this. Wonderful. Okay, well, I'm happy that you're all doing well. Stay safe out there. And if you have any questions, feel free to email me. You know I'm around. And I thank you all for your patience and understanding during these times. And I appreciate all the hard work you're all doing. And so if there's anything else, you let me know. I'll be here. Okay?
Okay, Professor.
Professor.
Thank you.